Welcome to Talk Tickers. Today, we are digging into Gap's third quarter earnings. And wow, what a report. The stock absolutely soared, jumping over 8%, and for good reason. It looks like management's playbook is finally really paying off, and the numbers are here to prove it.
All right, here's what we're going to cover. First, those headline numbers that blew past expectations. Then we'll get into the playbook that's actually driving these results. We'll also touch on the headwinds and the laggards in the portfolio. And finally, we'll wrap up with our take, the next call. So let's get right into it. So let's start with those headline numbers. And listen, this wasn't just a small beat. No. Gap came out and delivered a major surprise, beating on both the top and bottom lines. This really feels like the business is starting to pick up some serious speed. Okay, check this out. On the bottom line, Gap posted 62 cents per share in Gap earnings. Now, that might not sound like a huge number, but it beat the street's consensus by 3 cents. And that tells you they're running a tight ship, really showing some strong discipline on the operation side.
And it wasn't just about cutting costs to get that earnings beat. The top line, the revenue, also came in strong. We're talking $3.94 billion, which not only beat estimates, but also represents 3% growth over last year. You know, in today's retail climate, any growth is a win, but beating expectations like this, that's a whole other level. But if you ask me, this is the number that really matters. Company-wide comps grew 5%. Now, for anyone new to this, comps are a super important metric. They look at sales from stores that have been open for at least a year. And a 5% jump? That's the best they've done in over 4 years. It's a huge signal that shoppers are not just coming back, they're actually opening their wallets. So the big question is, how did they do it? How did they pull off a quarter like this? Well, it all goes back to what the CEO, Richard Dickson, has been calling his reinvigoration playbook. And this quarter, you could really see it working. I mean, it was firing on all cylinders, especially when you look at their marketing and how they're executing at the brand level. And this chart right here, it just lays it all out perfectly. You can see exactly where that strength is coming from. Look at this, Old Navy up 6%. The flagship Gap brand up an incredible 7%. And even Banana Republic is putting up a solid 4% gain. This isn't just one brand carrying the team, it's broad-based momentum. Now, we will talk about Athleta, don't you worry. And you don't have to take my word for it. The CEO himself said it. The playbook is working. This isn't just some strategy document sitting on a shelf. It's actually delivering real, tangible results. And you can feel it. It's bringing a sense of consistency and, maybe more importantly, a shot of confidence back into a business that, let's be honest, really needed it. So let's get into the specifics of how. I think this is fascinating. Take the Better in Denim campaign. This thing wasn't just another ad you skip past. It turned into a genuine cultural moment. I mean, over 8 billion impressions. That's insane. And it wasn't just for show. It drove double-digit growth in their denim category. And this is the really crucial part. It got younger Gen Z shoppers back into the store. That's the holy grail for a brand like Gap. Okay, so when you have a quarter this strong, what do? Well, if you're management, you do the one thing investors absolutely love to see. You raise your guidance for the full year. They nudged up their sales growth forecast and bumped their operating margin target to about 7.2%. That's a big vote of confidence in their own strategy. All right, but let's be real, it wasn't a perfect quarter. To get a balanced view, we have to look at the challenges too. It wasn't all sunshine and roses. The company is still dealing with a couple of pretty big issues, tariff headwinds, and a major drag from one of its most important brands. And that brings us to Athleta. This is without a doubt the biggest problem area right now. Comps were down a whopping 11%. Ouch. To their credit, management is being super transparent about it. They're calling this a reset year, and they're basically telling everyone, hey, this is going to take some time to fix. So for now, it's the anchor weighing down what is otherwise a really strong ship. The other challenge? Tariffs. Now, if you just glance at the gross margin number, you might think, it went down a little. But you have to look under the hood. That number includes a massive hit from tariffs, 190 basis points to be exact. If you pull that out, the underlying margin actually grew by about 120 basis points. Why? Because they're not having to slap discount stickers on everything. They're selling more stuff at full price, which is exactly what you want to see. All right, so let's put it all together. You've got amazing execution at Old Navy and Gap, but you've also got these very real problems with Athleta and tariffs. So what does this all mean for the stock going forward? What's our thesis? What's the play here? So here's the bottom line as we see it. The market is definitely noticing the momentum, but it's still hung up on the problems, especially Athleta. And that tension, well, that's where the opportunity is. So the question becomes, where does the stock go from here? And more importantly, how do you position yourself to take advantage of it? Okay, here's our official take from the next call. We're calling this the Athleta inflection trade. Here's the thesis. The turnaround at Old Navy and Gap is legit, it's real, and it provides a solid foundation for earnings. But the stock is still being punished because of Athleta. So what's the catalyst? It's any sign of stabilization at Athleta. Seriously, the moment that comp number goes from down 11 to even just down 5, the whole story changes. The narrative will flip from 3 winners and 1 loser to 4 improving brands. And that, my friends, is when the stock could get a major re-rating. So our call is to be long the stock. We're giving it an outperform rating with a price target of $30.
And, of course, we have to say it, this is not financial advice.